What is up, YouTube, and welcome back to another Fridge Financials video. And in today's video, the SEC is going to be making trading stocks cheaper for everybody here. So if you're excited for today's video or curious as to what in the heck Fridge Financials is covering, feel free to like the video, smash the thumbs up button, subscribe to the channel, and turn the bell notifications for all future uploads, of course. So what we're going to be talking about, as you will see, the U.S. Securities and Exchange Commission, the SEC, has revamped how stocks get priced in an effort to reduce costs on investors. On Wednesday, the SEC voted to adjust market rules so that some stocks will be quoted in increments of 0.005 or half of a penny in increments. And if you're wondering what that means, if you take a look at this example here, obviously Bitcoin is not a stock, it is a cryptocurrency, but it gets the same point across, and you can see it move in live time right now because it is the weekend. And as you will see, again, it goes all the way down to 31 cents. It goes on all the way down to 1 cent. You look at the stocks over here on the left side of my screen, they all go down to that 1 penny increment. But they're looking at going to having basically a third decimal value, which basically 0.005, which is half of a penny, as what the SEC has ruled. Now, why would they do that, and what is the purpose of it? This will lower costs for investors as well as improve liquidity, competition, and price efficiency in the markets. The 1 penny minimum has become outdated. It's too wide in many stocks. The focus of the rule is to narrow bid-ask spreads. The tighter the spread, the more money investors save. So what that means, and I'll go back to the Bitcoin as an example here, when you are buying stocks, crypto, for example, as you see here, you have what's called a bid-ask spread. What that means is the bid is what people are willing to pay for it, and the ask is what people are willing to sell it for. And it's a spread because it's basically saying, hey, I'll buy it down here, you want to sell it up here. We kind of meet in the middle and find that middle range value, and that's what usually gets bought up at. So what they're saying is that with having a 1 penny increase, or with having a 1 penny increments, the bid to ask spread could become too big. And what that means is that, say you wanted to buy a stock at $10, but the sellers are looking at $10.05, you have to pay 5 cents extra in order to own the shares if you wanted to, perhaps. Now, that doesn't seem like it's a lot of money, but imagine you're buying thousands of shares, hundreds of shares. It does add up if the bid to ask spread is too wide. For example, say that one stock you were willing to buy it at $10 and the seller was selling it at $12. Your middle point, your halfway point, would be $11, which means you're basically still paying $1 more per share. So the bid-ask spread is very, very important. If you have a very narrow bid-ask spread, you have a less chance of losing money by paying more upfront. For example, Bitcoins right now, as you can see, 62,456, 63,731. You're looking at about $1,300 difference here, which means the halfway point, you're looking at about 650, which is where this number comes in right now. And the problem is, again, is that you want to buy down here, they want to sell up here, you kind of have to meet in the middle, and that's why having too big of a bid and an ask is where investors lose a lot of money. So that's what they're focusing on saying here, is that if we make the increments smaller in stock prices, we can narrow the bid-ask spread. That's what their focus is on. Now, CNBC talks about this as well, and believe it or not, this has not been something that has been new. Before the mid-1990s, the stock brokerage business was very profitable. Since the 1800s, the smallest increment that a stock traded at was an eighth of a dollar, or 12.25 cents. That was the smallest you could trade a stock for. Not in 1 penny increments, but 12.5 cents. A broker might have a bid, a price which they would be willing to buy at $20, and an ask, that is, a price they'd be willing to sell at $20.25. $20 and 0.125, an eighth of a dollar essentially. Basically what that means is that if you want to buy the stock at $20, but he's selling it at the lowest you basically will sell it at, which would be an eighth of a dollar higher, you have to pay that. You have to pay that price. You don't get it at 20. You're going to get it higher than that, which means you're going to be spending more money than you want to. Okay, that turns out to be a very lucrative business. This all began to change in the 1990s. In 1997, the minimum tick size went from an eighth of a dollar to a 16th of a dollar. Then it dropped to a penny in 2001. These reductions in tick size has had a profound effect on the brokerage business. It made stock trading far less profitable, but it provided big savings to buyers and sellers of the market. Reducing the tick size also improved market liquidity. Liquidity is how available the shares are. If you have a huge bid to ask spread, you don't have a lot of liquidity and people are going to be willing to trade and buy the stock and everything else. When you have a very, very small bid to ask spread, orders get filled a lot faster and it creates more liquidity in the market. It provides more shares to be available for buyers and for sellers. It's liquid. It's moving around. It's moving between hands in the market, essentially. So that's what we're really talking about here. As the volume of trading the largest stocks has expanded, the trading community has debated about whether tick sizes should be reduced further. For starters, certain high liquid stocks are tick constrained, meaning they could easily trade if the tick size was reduced further. So for example, Apple stock already trades it's very liquid. It trades every single second on the market, whenever it opens to when it closes, right? And they would trade even more if they had half of a penny as a spread, as an increment, instead of a penny. That's what they're saying here. There have been discussions about adding tick sizes of a tenth of a cent, a fifth of a cent, and as well as a half of a cent. Again, this will reduce trading costs because people aren't going to be paying as much. Investors who dread the idea of their favorite stocks being quoted in half penny increments will have some time to get used to it, and will have to likely get used to it, of course. So the SEC also, again, this is another way of breaking it down here as well, okay, is talking about how it works. So every time stocks are bought and sold, there's always a third party that makes the trade happen. So if Fridge Financials wants to buy shares of Apple or Amazon or Google or whatever, and then somebody else wants to sell me those shares, we have what's called a market maker who's the third party who connects the two. He goes, I have this order for this buyer here. I have this order for the seller here. Let's make it work. And they're the ones that connect the dots, basically, essentially. And that's someone who basically it makes the liquidity in that market, who's connecting the buyers to the sellers. Okay. The market maker gets a cut of every trade by giving the seller of a stock a little less than what the buyer pays. The cut can vary based on how hard it is to match a buyer and a seller. The harder the match, the better probably the prices that the market maker will get for himself. The easier the match, the faster it goes. But again, it doesn't seem like it's a lot. But for popular trade stocks, the cut is often barely minimal. It could even be a penny. Say you want it at $10 and they want to sell it to you at $10.02. They might give you $10.01 and that market maker makes that 1 cent difference. Fine. That's whatever. That's totally cool with it. But again, there's thousands, millions of trades going on. So they're making a crap ton of money doing this every single day. SEC argues that by allowing popular stocks trade in half cent increments, transaction costs will fall. So people don't have to pay as much for buying shares. And unfortunately, people will not be making as much when they are selling it as much, right? So here's, again, a good example from Investopedia about what a market maker does. Let's say there's a market maker in stock XYZ. They may provide a quote of $10 to $10.05 or a 100 by 500, which is, I guess, in their words for it. This means that they will bid or they will buy 100 shares at the $10. They will also offer or they will sell 500 shares at $10.05. And what's going to happen is when people start to buy them and start to sell them, some of that, the difference here, the spread is 5 cents. And for example, if that's what was happening, say he was able to sell these shares at 500 shares at $10.05 or whatever else it is, he makes up the difference of the amount of money that they have. And if you're trading hundreds and thousands of shares a day, you're making hundreds and thousands of dollars every single time. So that's essentially what happens and how they are making their money, right? So market makers operate and compete with each other to attract the business of investors by selling the most competitive bid and ask offers. In some cases, exchanges may have designated market makers. That happened in Robinhood. They were talking about, I forgot what their market maker was. I'll put them on the screen though. In some cases, exchanges have the market makers, each of whom is responsible for making a market in specific securities. The specialist process exists to ensure that all marketable trades are executed at a fair price and a timely manner. So that's essentially what it is. And so the thing to take away from this is when you are buying a stock, if you were to go on to your Robinhood account, your Webull account, your Fidelity account, your Schwab account, and you see the bid-ask spread, if you say, hey, I want to buy this stock at $10, it might not get filled right away because you'll have someone who's only selling it at $10.05. And then you got to kind of basically find this common ground here essentially to make the order go through. So they're trying to match up people who want to buy and who want to sell it. And they do it in a way where they're able to make the amount of money is the difference, and they collect the money that they have. So that's essentially what it is they're really focusing on here, what they're talking about. Their idea behind it is basically if you can make the bid to ask spreads narrower, there's a lot less room for people to lose money as much. Obviously, that means the market makers won't make as much money, so they probably will hate this bill. But it allows more liquidity in the market, more people to buy shares and to sell shares. and to not lose as much money as they might be doing right now. So that is what is happening in the market. I didn't even know this is a thing, but apparently it is a thing. We're going to be having some half penny increment stocks. So thank you so much for watching today's video. If you made this fun the video, make sure that you consider to like the video, subscribe to the channel if you've not already done so, turn on the bell notifications for all future uploads. I hope you're making money in the market as per usual, even in half penny increments, and I will see you guys in the next video.